Elliot Hershman, CPA MBA from Alpha Professional Services, will be our presenter tonight on tax planning issues for real estate investors.
All right, so this is who I am. I'm a CPA, MBA, and I've spent some time in the construction industry when I was younger. And I really focus on the needs of people in the construction industry and the real estate industry. So I have a number of contractors and a number of real estate agents as clients. We're just going to cover tax law, but if you have any questions that are specific to your own needs, I'd be happy to talk them over with you. Now, my office is located in Willow Grove. My partner here, Tom, has an office in Bluebell. So together we cover a large range of area. Of course, we don't have anybody in Quakertown yet, but we'll work on that. Just to get started, let's see what we can find out as our first screen. So as you all know, I'm sure, our president was the driving force behind the Tax Cuts and Jobs Act. And that was back in December 2017. And that really helped a lot of people to manage their tax liability. Alternative minimum tax pretty much went away for all intents and purposes. And people in the six-figure range know that, and they're very happy about that. And also, there were some changes to things like the Schedule A and the standard deduction. As a result, a lot of people don't need to itemize their deductions anymore. For example, a married couple will have a standard deduction of $24,000, which is much bigger than it used to be, and really eliminates the need to count your medical expenses and your real estate taxes and your mortgage interest unless you really can exceed that number. And there are, of course, a number of people who can. So we always have to calculate the Schedule A deduction just to make sure that people can take advantage of it or not. Of course, there was an initiative to create a postcard-sized tax return. That's history. We gave up on that. And in fact, the postcard was actually designed to have 6 different schedules feed into it so that you could make it a postcard. I'm not sure why we needed a postcard. Nobody wants to send a postcard with their social security number through the mail. But at any rate, the good news is for 2019, those 6 schedules have been simplified down to 3, and the idea of a postcard has been abandoned. So that's all good news. In fact, as far as the standard deduction is concerned, I just want to mention that over 126 million taxpayers chose the standard deduction in 2018. So it's obviously going to be normal for a lot of people. So let's change the screen. So you might have heard about the state and local tax deduction being limited to $10,000. As a result, people who have high taxes in high tax states like New Jersey, California, New York, have much more limited options in terms of being able to deduct their real estate taxes. Certain people in this room probably are familiar with something called the Domestic Production Activities Deduction. That was a deduction that contractors, architects, and engineers could take advantage of if they were producing or providing services in the United States. And that was actually a 9% deduction, which is similar to what we've got now in certain respects, but the Domestic Production Activities Deduction has been eliminated. But we're going to talk about what's replaced that pretty soon. One of the things I want to make sure people are familiar with is something called unreimbursed employee business expenses. If you're working for an employer and you've got out-of-pocket expenses that you used to be able to deduct, you can't do that anymore. So if you're ever in that situation, you should be talking to your employer about some kind of reimbursement plan. So let's keep going. Oh, of course, the cost of meals is now only 50% deductible, and entertainment is 100% non-deductible. How they got attorneys to agree to that, I have no idea, because attorneys are famously, go ahead, what are you going to say?
So what's the alternative? Obviously, that's not being followed exactly that way. So what do they call it that allows them to deduct it?
Well, if you're going to be buying food for your office, and it's meals, there's certain of those things might be actually office supplies. Entertainment's a tough one. I'm not sure how to get around that one. If you're buying a ticket to a football game, you're
So you're telling me all the box seats at all the stadiums around the country are no longer deductible?
That's correct.
They must call this something else.
And not only, well, I'm not sure about that. I think, well, there's other ways. Is there any way that you can deduct the cost of a football game ticket now? Yeah.
I don't know. I mean, that no is the answer officially, but what's the unofficial answer?
There's no other answer. In fact, it gets even worse. If you have meals that are served as part of that entertainment, those meals are non-deductible as well. So
What do they call that?
out of luck is what they call
Office supplies.
What's that? Yeah, sure. Go ahead.
So a couple things. Elliot talked about the itemized deductions, which are.
If you're going to answer a question, would you grab the microphone,
yeah, come on
if you don't mind?
No, so when you itemize your deductions, you get the higher of your itemized deductions, which include your deductible medical, your state and local tax plus real estate tax, which generally cannot exceed $10,000, your mortgage interest, investment interest, and charitable contributions. If that doesn't exceed for a married couple $24,000 this year, then you get $24,000, which is the standard deduction. So one of the things you can do is you can, if you're charitably inclined, bunch your charitable deductions into 1 year so you jump over that $24,000. If you're somebody who normally gives away $2,000 a year, there's ways to front load your charitable deductions to get over the threshold so you get the benefit as opposed to having $2,000 for 5 years. So that's something you can look at. And as a real estate investor, in addition to the $10,000 cap on taxes that you can deduct for itemized, if you have a piece of raw land that you're holding for investment, the taxes on the raw land can be deducted after the $10,000 exclusion. You're familiar with that? That's the. So you could deduct real estate taxes plus your state taxes to Pennsylvania plus whatever locale you're in up to 10 grand. If you hold investment real estate for investment purposes, raw land is a good example. Those taxes can be deducted after that limitation. There's a line on there that says other taxes. There's a position to take that you could actually deduct that. So your real estate and state and local tax deduction can actually exceed $10,000. The other thing is, if you do own raw land, because you can make, this is related to itemized deductions. Normally the investment expenses potentially were itemized deductions as miscellaneous deductions. Since there's no more miscellaneous deductions, you might want to consider what's called a Section 266 election. Is anybody familiar with that?
You're going to have to explain it now.
266, just write that down and ask your accountant or whoever does your taxes. It's basically, if you own land and you have carrying costs for the land, you can capitalize all the carrying costs. But you have to make an election on your tax return to do it. And then you'll get the deduction when you sell it because your basis is higher. So 266 election, but don't make it on the real estate tax part because you can deduct that in the current year. And then with respect to the entertainment, if you do go to the Eagles game, you can deduct the cost of the hot dog that you buy for your colleague that you bring to the game, but you can't deduct the ticket.
I can't believe that that's actually happening.
And if you get a ticket
the
that
stadiums
includes,
will fold up.
if you're in one of those boxes and they provide food as part of the ticket, you can't deduct that. But he's right, you can deduct the hot dog.
Yeah, the other thing I want to mention is even though Elliot mentioned that for unreimbursed business expenses, you can't deduct them on your federal return anymore. You can potentially still deduct them if you have them and you don't have an employer plan on your Pennsylvania return,
Right.
and your local return. So it's not worth that much, but you can.
Right. Okay, thank you, Tom. All right, let's keep going. All right, qualified business income deduction. Okay, so this was what I was talking about as a replacement for the domestic production activities deduction in some cases. So the qualified business income deduction, well, when Congress passed the Tax Cuts and Jobs Act, it reduced the C corporation tax rate from 35% down to 21%. So C corporations benefited extremely, but Congress didn't want to disadvantage owners of other types of entities like partnerships, sole proprietors, and S corporations. So Congress created something called Section 199A, also known as the Qualified Business Income Deduction. This deduction has some limitations. I'm obviously not going to be able to cover them all, nor do you want to hear about it. But the most likely scenario is, for example, if you're married and make less than $321,000, the rules are much simpler. So basically, you can get a 20% deduction on your business income right on page 1 of your Form 1040. So it's a great benefit, and you're certainly going to want to take advantage of that. For simple scenarios, this is now in 2019, there's a Form 8995, which is the Qualified Business Income Deduction Simplified Computation. So I'm guessing that the people who are involved in managing a business, you're definitely going to see that in your tax returns. The more complex one is much longer. It's 6 pages, has 4 parts and 4 schedules. You don't want to know about that. But that's for people who make over $321,000 as married couple. Now, there's some uncertainty about how to calculate the qualified business income deduction. I'm sorry? Well, actually, there's a strange nuance. In order to calculate the qualified business income deduction, you're supposed to deduct certain things from your from the deduction, and maybe Tom might be able to explain this better. But basically, Congress made a mistake when they wrote the regulations. So it's possible to have something like self-employed health insurance deducted twice before you can calculate the qualified business income deduction. So talk to your accountant about that. Make sure that they're not doing that, because I think that Tom and I would agree that there's no need to reduce your qualified business income deduction by certain expenses twice. And there's some software out there that makes that mistake. So always ask that question about how it's being calculated. All right, qualified opportunity zones. This is one of Tom's specialties. But basically, the qualified opportunity zones are a way for public policy to encourage taxpayers to invest in areas that are low income, depressed areas. Now, the rules are very complicated, and it requires a very long-term commitment. But there are incentives. You can defer gain recognition on your investment. You get a basis step up on your original investment. And there could be a permanent exclusion of gain on your investment as well. Tom, you want to talk about this a little bit?
Is anybody familiar with them? Just a couple.
Yeah, go ahead.
They're extremely complex. And if you didn't make a contribution to a qualified opportunity zone fund by the end of last year, you kind of lost some benefit already. But it allows you an opportunity to defer tax until 2025, end of 2025, and get a haircut on how much gain you have to pay tax on. There's certain requirements, and it's very restrictive on how you invest those assets or those funds. And there's a certain way to present it on your tax return to indicate to the IRS that if you had a gain, that you're basically using those cash proceeds to invest in a qualified opportunity zone. That gives the opportunity, but that allows the IRS to track it. I question whether these are really worth it, because you basically have to hold the investment for 10 years. The ultimate gain on the opportunity zone fund, assuming it's sold at a gain, would be tax-free if it's held for the requisite period. But you also run the risk of, if you do this, that if capital gains rates go up based on a change in Congress or president, you're paying the higher capital gains rate, even though you got the haircut or the increased basis on the transfer to the opportunity zone. For those that got in early, this is decided, I think there were significant opportunities for those that already owned opportunity zone investments before they passed this, or those who bought the properties early. Like, my understanding is, and you guys know better than I do, but Hudson Yards in New York is an opportunity zone, and it's going through the roof. So people who are in there, that's a great investment. So getting in early is kind of a key aspect to this. And some of the funds, the public funds that I've seen out there, they're basically structuring it because you have to pay your tax, part of your tax, within 7 years, at the end of a 7-year period. But they're structuring their funds so that they're building out properties, and that in year 7, they're going to refinance and distribute the monies back to the investors as a tax-free distribution, essentially, return of capital, so you could pay your taxes. So a lot of these public funds are kind of structuring because they know the tax rules, but it's extremely complex. I think the other thing you need to mention is that the qualified business deduction, the 20%, applies to real estate, assuming you meet certain requirements. So that's important to know.
Well, hold on. Keep going with the next slide.
Oh, no, you're getting me in here. What's the next slide?
All right, so the Secure Act was just passed, just signed by our president recently, and eliminates the age limit for making traditional IRA contributions, increases the required minimum distribution age, allows penalty-free withdrawals for birth or adoption. So anything you'd like to add about that?
Well, it gets rid of the stretch IRA. Is anybody familiar with the stretch IRA? Yeah. So the stretch IRA is if you have an IRA account and you basically, when you pass, if you're the second spouse, usually most people, if they're married, you would name their spouse as the beneficiary. Then the spouse passes away. The surviving spouse eventually passes away and generally leaves it to their children. The children generally can string that distribution over their lifetime. That has been changed so that if your children are inheriting an IRA account, those funds have to be dispersed over 10 years. They're just accelerating because they want the tax money, accelerating the distribution. So that's something, there's some planning around that and some things you can do that are maybe beyond the scope here, but you could think about who the beneficiaries are. You can, if you're in a lower bracket because you're retired and your children, maybe because they're older, will be in a higher bracket, maybe it makes sense to take more out of your IRA than less because you're taking out a lower bracket and let them inherit cash that's outside the IRA. The other thing is if you're charitably inclined, you could use something in a charitable arena called the Charitable Remainder Trust, where you can leave it all to a Charitable Remainder Trust, tax-free, and the beneficiary of the Charitable Remainder Trust is your children, which you could pay out over a longer period of 10 years.
Does the 10-year time period also apply to Roth IRAs?
Roth IRAs don't have distribution requirements. If you can get money to a Roth, that's the best thing. So in a year where you might have significant losses, or like last year, for example, this is a sidebar, is this okay? I had a client who, I just did this 2 weeks ago because they entered a retirement community, one that you had to pay like an upfront fee, and it was a advanced care. I don't know the technical name, advanced care communities. You guys probably know the terms better than I do, but they paid $400,000 up front. Of the $400,000, 40% was deductible as a medical expense of the entrance fee. In addition, 40% of their ongoing monthly maintenance fee is deductible. So in that case, for 2019, I had a huge medical expense deduction. They're already withdrawing from their IRA. So the medical expense deduction was so large that it basically wiped out their IRA distributions. So I figured out exactly how much of their IRA they could take out and roll to a Roth without paying any tax by using their deduction for the entrance to the retirement community. Same can apply, like if you have significant real estate losses, is there a way, hey, this year I expect a lot of losses because of, I don't know, a couple of properties that just didn't make money. That might be an opportunity to figure out exactly how much you could take out. You don't have to convert all, you can convert whatever you want to a Roth. And that grows essentially in perpetuity.
So that 40% number that Tom mentioned, I think that's facility specific. Wouldn't you agree?
Yes.
And you need to look at the agreement. 55 plus, right. You have to look at the agreement that the community provides you to determine what the percentage is. But it's absolutely a great tax planning opportunity. I'm not expecting to get into the use of IRAs for real estate investment. In general, it's a bad idea. I know people do it. And I would say...
Why is it a bad idea?
What's that?
Why is it a bad idea?
So many reasons. There's a lot of forbidden transactions that are involved in the use of IRA money. One of the ways you can take advantage of IRA money is if you and another person who is not related to you are planning on doing the exact same thing. You could actually lend money out of an IRA to another person And I don't think there would be any really negative consequences there because it's really just basically a loan. And the other person can do the same for you. So in effect, you could use that IRA money that you're borrowing from somebody else to invest in real estate. Other than that, I don't know a lot of good scenarios where that's a good idea, but I'm sure Don might have some ideas about that.
Well, Rich and I do it all the time. So I don't know. I haven't found a bad, well, there are.
Well, you don't want to hold real estate in an IRA. I mean, you certainly don't want to do that.
No, when you say hold, you mean as in hold
As part
a
of
rental
the IRA
apartment?
asset.
Like hold a rental apartment?
Owning real estate in an IRA is a bad idea. That I can say for certainty. If that's what you're doing, we should talk.
Well,
right, and that's fine. That's fine. Yeah, right, exactly.
right. You just call up CAMA or Equity Trust or any other.
CAMA plan, right?
What did I say?
CAMA plan?
Right.
Yeah.
And they'll tell you how to do it. So I don't. Maybe we're not speaking the same language here, but
All right.
it's done all the time. It's done a lot.
Well, as I said, taking money out of your IRA to lend to someone else, that's okay. But buying real estate inside of an IRA is
For
a bad idea.
yourself, yeah, that's you can't. You're not allowed to do
Yeah, it's a
that.
forbidden transaction. Right.
Yes.
Okay.
Right.
All right. That's why I didn't need any help on that one. All right. So there is another
Your
law
audience
coming
has
up.
grown here, Elliot.
Oh, I'm sorry.
Your audience has grown.
That's great. Welcome, everyone. You missed a lot of good stuff already. Not really. It's okay. Well, if you're doing something with CAMA plan, I'm sure they're doing the right thing for you. But there are certain forbidden transactions that people think that you can do with IRA money that you can't. So as long as you're following their guidelines, I'm totally okay with that. All right, let's talk about other changes in the tax law. Something called
I'm sorry.
extenders.
Could you go back one slide? I'm
Sure.
sorry. So your second small bullet there increases the RMD age to 72.
Right.
When does that begin?
I think that's in effect 2020? 2020. 2020.
So 2019, it didn't apply? Shit.
No, but you already started your grandfather.
Well, I've already started. I didn't want to start. That was the point. Okay. Sorry.
All right. Not a problem. And the last item I added recently, 529 college savings plans can be used to pay student loans. That's a new regulation. It doesn't really match the rest of the elements in there. I guess must have been some lobbyist who made that happen. So the next slide talks about extenders. So it's a term used to refer to expired or expiring tax provisions. So there's two appropriation bills that are actually signed into law. So we're going to see the mortgage insurance premium deduction again. So anybody who's got a mortgage that's more than 80% of loan to value, I think they're going to be able to take a deduction for mortgage insurance as well. Medical expenses deduction was originally 7.5%, was raised to 10%, back down to 7.5% now. If you're not familiar with that, that's a good thing because that means you didn't have high medical expenses, so don't worry about it. I'm talking about Schedule A deduction.
Repeat the
self-employed.
question, please. Repeat the question so we have a record of it.
Okay, so so your question was, does that apply to the self-employed health insurance? Self-employed health insurance deduction shows up on page 1 of your Form 1040. It doesn't show up on your Schedule A. If you're self-employed and you've got health insurance expenses, health insurance premiums, you can deduct it on page 1 of your Form 1040. If you don't, like most other people, there's a medical expense deduction on Schedule A. That Schedule A had certain limits, so you were only able to deduct medical expenses that exceeded 7.5% of your adjusted gross income. That was raised to 10%, and now it's coming back down to 7.5% again. Also, qualified tuition deduction is also coming back in, so that means that if you've got any kids going to college, you'll have some more deductions. That's a good thing. Let's take a look at tax rates. So what you'll see here for married filing jointly, People who are under 19,401 are paying 10%. And I guess the vast majority of people are in that next block from 19 to 78,000, and the rate's 12%. Above 78, it jumps to 22%, and then it gradually goes up from there. Now, the next screen is interesting because capital gains tax actually is shockingly low. If you're married filing jointly, you have capital gains tax only on the amount that capital gains exceeds $78,750. Right, Tom? Does that sound right to you? It's pretty outrageous, isn't it?
So up to the first, so for married filing joint, up to the first $78,750 of taxable income, if there's capital gains in there, it's zero. The tax rate's zero on it. So the $78,750 is after the standard deduction or after you itemized. So it's your taxable income. So really your income could be, if you're married, the exemption's $24,000. So it's $24,000 higher than that. If your wages were $25,000, and if you add $24,000 to the 78, that's almost like 100. You can essentially have, you can have capital gain for the difference and pay zero tax on it. So you could pay zero tax up to the 12%. That's actually the 12% bracket, I think, right? I think it's the 12% tax bracket. So it's a great planning opportunity for kids. If you have kids and maybe they're just starting their job, they graduate, they only have a half-year comp, or they just have a summer job, but they're not minors. You can maybe gift them appreciated securities. They sell it, pay zero tax, versus you selling it, paying tax. So there's a way to shift wealth to the next generation also.
Terrific. Thank you.
There's a question here, Elliot.
Yes.
This is part of the 2017 tax cut and
Yep.
jobs. Does that sunset in 22?
I think it's 2026.
Yeah, but it's always been around. So there's always been the 0% capital gain rate.
Get close to the mic, please, Tom. Tom, close to the mic, please.
The brackets were lower. But
Yeah, there's always been a 0% capital gain rate, even before this.
I was actually more concerned about the last page.
The tax rates, they expire. Yeah, these all
They're going
change.
to get awful, right? In 22, from what I understand.
They're what's that?
They're going to get really awful.
They're going to go back to, the highest marginal rate was 39.6 on income of about, it's all inflated. So maybe it was about, like under old law, it was probably 39.6% on like 400,000. So yeah, they're going to get worse. And a lot of people say, oh, my taxes went up and they changed the tax law. That's not really true, because a lot of people get salary. When they pass this tax act or tax cut bill, he likes to call it the cut bill, the tax cut bill, they automatically adjusted everybody's federal withholding in February of that year so that people would bring more home. So the withholding tables changed. So people at the end of the year say, my refund's less money. And not realizing, but your tax liability went down, but you have less withheld. So you did have lower taxes. They just gave it to you up front because they wanted you to spend it. So
I'm curious, how many people got a smaller refund or end up having to pay when they
Closer to the mic, please.
Nobody's raising their hands. There's a couple. There's a few.
Yeah, so tell us where the tax cut part comes.
Well, let's see. Maybe we can get a Republican.
let me show you my shirt underneath there. Make America Great Again. No, I'm kidding. So first of all these tax rates are all reduced. I mean, there's people paying zero tax based on these. If you compare this to the old tax rates, it's dramatically different. One, the qualified business deduction is a gift to everybody in this room. It's a gift. It's 20% of your net income, assuming you fall below the thresholds, is reduced before you calculate your tax. That's a gift. That's a huge benefit to real estate investors, because it applies to real estate investors under certain circumstances if they provide at least 250 hours of services to those activities. That's a significant cut. If you're a couple, and this is not on the slides, if you're like a couple with 2 young children, significant tax cut, because the child tax credit increased significantly and it's refundable. But the QBI deduction is really significant. If your income's over 400,000, that's the ultimate phase out. You said 315, but it's 315 to 400. Once it goes to 415, there's other limitations based on whether or not you have, based on salaries and the type of business that you're in. But the QBI thing is really significant with respect to the Tax Act. There's certain businesses that have limitations. Like if you're in a business that has specialized services, and it relies on the expertise of the people providing those services, like Elliot or myself, those are called, is it specialized? Yeah, it's a specialized service business. There's more limitations on people that provide consulting, that people provide legal advice, people provide tax advice, people provide investment advice. Like I think a couple of people are lenders. You would probably fall in that category, that you're limited. If your income, you're only limited if your income goes over 315. Then there's a 315 to 415 phase out. Over 415, if you're fortunate enough to have over 415, it's more complicated, but there is still potentially a benefit.
Anybody want to admit to making over 415? I didn't think so. Okay.
Is that
Don't go away because
lira or dollars? Wampum.
Congratulations. I'm sorry, what's that? Okay.
Repeat the
Well,
question, please.
Yes. So what are the requirements to get that 20% deduction? You have to be have a small business, or you have to have a business. Forgetting the higher income levels, if you have a small business, if you have a business, you can generally get that 20% deduction automatically when your tax return is being prepared. There are certain exceptions. It's kind of out of the scope of what we're covering here. But it also applies, as Tom mentioned, to rental real estate income. So for those people who have lots of rental properties, those properties could be considered eligible for the 20% qualified business income deduction. However, there are some exceptions and regulations that you have to follow. For example, you have to treat the rental real estate as a business, which means instead of not having to issue 1099s, as most people do if they have rental real estate, in order to qualify for the qualified business income deduction, you're going to have to do things like send out 1099s to your contractors. They don't like that very much. Nevertheless, you got to do it. And there's some other things that are required as well.
You have to, so for real estate, you have to obviously you have to treat it like a business. And there's a court case, I'll give you the name of it. It's Grotzinger or whatever. And the case actually relates to gambling and what constitutes business in a professional gambling setting. But for real estate, you have to keep separate books and records. You have to provide services, not services that would fall under the category of that of an investor. So you have to keep books and records. You don't necessarily have to, weld the pipe together, but you at least have to show up. You're meeting with a subcontractor about welding the pipe together. You have to issue 1099s. If you use a management company, you're probably nixed out of it because management company handles a lot of that stuff. If you have a triple net lease, that's bad. You don't qualify. Triple net lease properties don't qualify for the deduction. But how the deduction works is everybody file Schedule C. Or what do you do? C, or LLC. People have LLCs, but they file Schedule C because they're single member. So in Schedule C, you start with your gross income. You subtract all your expenses, none of your entertainment, right? None of your entertainment, just your meal, 50% of your meals.
None of your entertainment.
And you come, whatever you call it, marketing. And then you come down to the net income.
Business development. And
that net income, so like let's say you have Schedule C net income. Let's say you're somebody who has a self-employed 401k, a SEP account. SEP, ring a bell, anybody? SEP IRA? Or if you're somebody that has a solo 401k, you deduct that from there. You deduct your employee health insurance that Elliot mentioned. And that net number times 20% is another reduction. So you're paying tax on a lower number. You don't need a business entity.
You can be a sole proprietor.
Now, some people have anybody have an S corp? No, oh, good. Oh, we have an S corp.
There's one.
So that's
Any
a
other S corps in the
that
room?
could be a problem. But
Why?
so if you have an S corp or you have a partnership, partnership. If you're a partner in a partnership, you can't get a W-2. Everybody know that? You get guaranteed payments. In an S corp, you get a W-2. So in an S corp, people do S corps to kind of like maybe save on Social Security taxes. So if you had an S corp that had $100,000 of income, gross income, and you paid yourself $10,000 in a W-2, you're going to pay all the taxes on that. So your net income, let's just say there's no other expenses, is 90. The 90,000 goes to your tax return and it's eligible for a 20% reduction, right? Well, how can you increase that deduction? Take no salary, right? Because now you have 100,000 passes through to you and you get 20% of that. So people were starting to manipulate their salaries. The problem with an S corporation is that you have to take a reasonable salary. The IRS will be all over that if you don't. So there's something called reasonable comp. In a partnership, guaranteed payments, same thing. You take a guaranteed payment, that lowers the income of the partnership that's eligible for the 20%. If you have a lower guaranteed payment, that increases the income of the partnership, and you get a bigger 20% deduction. So people were maybe manipulating their guaranteed payments. So there's a lot of planning around that.
How about, did you answer the same question for LLCs?
Well, an LLC is basically treated, if there's an LLC with two members, it's treated like a partnership. Same law. So an LLC is member managed LLC is treated exactly the same as a partnership. A single member LLC gives on your Schedule C, same concept, but there's no guaranteed payment in a single member. It's just your income.
Annie has a question. Repeat the question.
Wait, you said for rental properties, why do you file? I think she asked, why do you have? A rental property is Schedule E, but if you're a realtor, I think a couple of people said they're realtors, they would have Schedule Cs.
Schedule C is small business. Schedule E would be for
Schedule E would be for rental, and that applies to the rental if it's a qualified rental for the 20% reduction. I was just trying to give an example to somebody on a Schedule C. Same thing, whether it's Schedule C or E, it's the net income times 20% is a deduction.
So under certain circumstances, the 20% qualified business income deduction can apply to your rental real estate income.
Close to the mic, please.
Sorry.
That's my job. Sorry.
Under certain circumstances, the 20% qualified business income deduction will apply to both your Schedule C, small business income, and rental real estate income under certain circumstances. So you have to make sure you follow the rules. In other words, make sure that you issue 1099s to your contractors, have a separate set of books and records, and a number of other things. And if you have any questions, you can talk to me after the meeting.
So, Elliot, question for you.
Yes, sir.
In the past, flippers, if they flipped, I forgot the number, 2 or 3 flips a year, the income they earned on those flips would be considered almost like a hobby, if that's the right word for it. And if they flip more than that, which happens often, it's treated differently. Do you know what that number is and how that's all handled?
Well, I think I understand what you're talking about. And so bottom line, the IRS wants to get as much tax out of you as they can. So if they look at you and they say to you, you're a flipper, that's your business, that's all Schedule C income. That's small business income. So you're going to have to pay ordinary income tax and self-employment tax on all of the money that you earn in general. Now, obviously,
from flip 1 on.
I'm sorry?
From flip number 1 on.
Well, if you're a flipper and this is what you do year round, that's your business, that's your main business, yes, it's all going to be subject.
Am I asking the right question? You know what I'm trying.
No, I'll get to what you're talking about. Okay. Now, if you're looking at just owning one rental property, you could actually consider that to be, and you sell it, well, if you sell it in the year that you bought it, there's a good chance that you're going to have to pay ordinary income tax rate just because it's a short-term capital gain. But if you hold it for longer than a year, then it becomes a long-term capital gain, and you might want to consider that instead of being business income, it would be in the form of an investment that you're getting a return on. So you're getting a long-term capital gain back. So that would be a much lower tax rate than ordinary income tax rate. So the real question is, how's the IRS decide whether your business is flipping or whether you're an investor, whether you just have investments that you get a capital gains on? It makes a huge difference as far as the bottom line is concerned. Now, you might want to say, well, if I do 3 or less properties a year, I'm not a flipper, I'm just doing investments. But if you're selling the properties the same year that you bought them, it's being taxed at ordinary rates anyway. The only question in that case is whether you're going to have to pay self-employment tax on it. And the IRS is going to look at the amount of activity that you've got. And I really think that it depends on the exact terms of each individual's circumstances. So conceivably, 3 properties might be considered investment activity, or they could be considered business activity, depending on the other facts of the case. Tom, you have any thoughts on that? Because I don't know that we can pin that down. I can tell you this, though, if you're doing flipping as a full-time job, it's probably going to be taxed at ordinary income tax rates, and you could conceivably be subject to self-employment tax also, which is 15.3% on top of your ordinary income tax. That's a lot of tax. Yes, back there. Are you just scratching your head?
No, I didn't have a question.
Okay, go ahead.
So if you're in a situation where you purchased a group of properties because you were planning to establish some rentals, but there was significant changes that are documented, that you can provide a support that you have decided to pull out. So now you're going to sell these properties. Do you think that type of an explanation, if you have resolutions that outline what you were planning to do, you have documentation, this is happening in Philadelphia, where the landlord requirements are changing drastically, and it's just not going to be a smart move to hold some of the properties that we purchased initially.
Repeat the question.
Now you have a handful of properties to offload.
So basically what she's talking about, if you stay under 4, you're not considered a dealer. If you go 4 or more, you're a dealer, so your economic status changes relative to the taxes. So in this particular scenario, your intent was one thing, which was to rent, but because of the changes within the city, you decided you're going to sell, but that's going to affect you because you're going to be selling more than 4 properties.
Well, okay, so the first thing I'm hearing is you're going to sell a property
Repeat
that
the
you bought in
question,
the same
please.
year?
Elliot, repeat the question for
I
the
just want to
record.
make sure I understand the question. So you're selling properties that you bought within the last year?
Yes.
Okay, so they're going to, all right, so if you buy properties and sell them in the same year, any gains are going to be subject to ordinary income tax rates no matter what. I think we can agree on that. The only question is whether or not it's going to also be subject to self-employment tax. And if there's, are we talking about properties that have been highly improved or no? All right, so you're probably not really looking at significant gains in that case. Is that a valid observation? Okay, well that's not bad. You're- Are you doubling your investment? No. Darn. Okay. So all right. So why don't
Yeah, I
you?
was just going to say, I think the question is, because we talked about, how many properties before you're subject to self-employment tax. In that circumstance, you're an investor. You don't have to pay self-employment tax on that. I think that's what you wanted. At least that's what I would. There's no way I would make you pay self-employment tax on it, because you bought them as an investor with the intent to rent them, not even intent to flip them.
What's your full name?
Elliot Hershman.
He's a Republican, so don't.
I'm Foglia, the Republican.
Actually, I wanted to clarify my question, and Jacob clarified it for me, and Timothy just used the right word, but I want to make sure you've heard what we're saying here. The question is, when does the IRS consider you a dealer? I'm talking about real estate now. Because I think, at least historically, if you flip I think it was 2 or 3 properties, you're not considered a dealer. And if you flip more than 3 or 4, some number like that, you are considered a dealer. And what does that mean?
Well, what's the rest of your tax return look like? Is that a small portion of your income or a large
Let's
portion?
say, well, we're
That
talking
matters.
about, we're talking about flippers who do this for their living.
Okay, well, if you're a flipper, then there's a good chance that it could be proven that you're doing this as exclusively to make a living, and it's all considered to be short term, and this is what you do for a living. It's a business. So I'm not sure that I'd want to take
So
a chance.
the definition of a dealer is not how many you do, but that's what you do.
I think so. That's a big piece of it. Again, there are a number of factors, and frankly, I'm not sure I can speak extemporaneously on that.
If you stay under 4, you're okay. If you go 4 more,
That's not what he just said.
no, but that's the case. 4.
Okay.
4. If you stay under 4, you're definitely far less likely to even fall into.
Well, I think that's right. And again, it has a lot to do with how much income you're generating and whether the IRS.
So
is
Timothy
sniffing
makes
around.
at least $100,000 on every flip, at least 100,000.
And you have
So-
no other sources of income?
And I'm only kidding about the 100,000. It's 120, but he won't say that. So times 4 is, it's a nice income. I don't know how much he makes for a flip. I'm just making a joke here, but so it's a substantial. Let's say it's a substantial income let's say for 3 flips a year, right?
Okay.
Is that considered a dealer? I mean, what's the definition of a dealer? I think is really our question to you.
Right. And again, it depends on the person's
depends-
tax return, depends on the circumstances.
Okay, what's it depend on?
All right. I'll tell you what, see me after the meeting and we'll talk about it a little bit more because I can't come up with that information off the top of my
Is that
head.
the next slide?
Interesting question. No, I'm afraid it's not.
We won't let you
wanna
out of the
comment
room
some
until
more
you
about
answer
that?
the question, Elliot.
The great thing about what we do is there's no answers. It all depends. That's why we get paid.
You say that a lot.
No, but it depends on every circumstance. Like if you're a flipper and I have a full-time secretary, I have an office. Those are like bad facts, right? Those are bad facts. That makes you more of like I'm in the business. I hold inventory. I hold them over a year. I don't know if a number defines it. It's just more of like how do you conduct yourself in that activity.
This only shows up in an audit.
Right.
Well,
So-
it shows them on the other flip side to it is, we're talking about self-employment tax. I don't know how much you're going to make, but on one hand, if it is a trader business and it's not short-term capital gain, but it's still ordinary income, right? Same rate. Are we on the same page there? Still ordinary. You get the 20% business deduction.
That offsets your 50% Social Security.
So is it really, it depends on how much you make, but you get a 20% business. You don't get a 20% business deduction for short-term capital gain. See Elliot Hershman.
Just remember, folks, that back a long time ago when I was just a gleam in my dad's eye, there were 70% tax rates. Luckily, we're in a much better situation than we used to be in that regard. So, I'm happy to talk to you about that. And I can even do a little bit more research if you're really curious. All right, so we covered capital gains, and let's move on to depreciation. Okay, now this got a little complicated, but it's all good news for the most part. So 15-year recovery period for qualified improvement property. And that's an improvement to an interior portion of a non-residential real property. How many people are invested in not non-residential real property? Anybody at all? Maybe this isn't something that isn't the right crowd for this.
Non-residential real property, you mean apartment,
Anything other than
commercial
residence.
buildings?
Anything other than a residence, yeah.
Okay.
Yeah. All right. If you're interested in buying a car or a truck, now's a really good time to think about that. Depreciation on passenger vehicles has gone up considerably. But just to go over, qualified real property is defined as any qualified improvement property. For example, improvements to non-residential real property, including roofs, HVAC systems, fire protection and alarm systems, and security systems. So in the past, commercial property had to be depreciated over 39 years, and this has reduced it to 15 in a lot of respects. So there are some benefits to investing in business property in that respect.
Is that for commercial property or for residential
For
property?
commercial property.
Okay, the 15-year depreciation.
Right. Now, the Section 179 expense, is there, I'm going to assume that some people know what Section 179 is. Basically, what Section 179 does for you is you can immediately expense an investment in a capital asset, like equipment, furniture, things of that nature. So you can have immediately expense those investments. So instead of depreciating something over 5 years or 7 years, you can expense it the year that you buy it. It's a huge benefit. So always consider that. And now Section 179 property now includes property to furnish lodging. So for residential real estate, yes, go ahead.
Is that retroactive if you had a property that you did turn into a rental that happened to be furnished?
The question is it retroactive? And the answer is you can always file an amended tax return for the last 3 years, but the Section 179 property has been around a long time. And this rule has been in effect since the beginning of 2018. So 2019, 2018, you could apply it. And of course, going forward. Now, there's also something called bonus depreciation, which is also a huge benefit. Certain business assets can be expensed in the year of acquisition. Used property can now be treated as the same as new property. And also passenger automobiles, another good reason to get a new car, everybody. You can get the bonus depreciation if you buy it in your business. Let's see, let's keep going. Now, the next slide talks about something called basis. Now, I'm going to assume that most people here aren't thinking about basis. If you were going to buy a house and pay cash for it, $100,000, that $100,000 would be your basis. If that property goes up in value to, say, $180,000, and you sell it, you've got an $80,000 gain. The way you calculate that is you take that $180,000 and subtract your basis from it. So basis consists of a number of things, including some closing costs and other things of that nature. But specifically for S corporations, and I know we've only got a couple people with S corps in here, a basis schedule is now a requirement when you file a tax return for an S corporation. If the shareholder receives a distribution, disposes of stock, or receives a loan repayment. So that's actually something that the IRS is looking at much more closely, because I think in the past people were abusing that a bit, and the IRS wasn't looking at it closely, and people were saying that their basis was actually higher than it really was. And if you take a sale price of something and subtract your basis from it, and that basis is a high number, what's left over is a smaller capital gain than you would ordinarily have had. So the IRS has increased their inspection of basis. Now, instructions for Schedule E have always required the attachment of a basis schedule to Form 1040, but the requirements have been expanded now, so you're going to see that a lot more. Now, if you have an S Corp, be sure to monitor your basis, because distributions in excess of basis could be subject to capital gains tax. Now, I thought that was actually a bigger problem than I think it really is, because we just saw the capital gains tax rate is pretty darn low. Let's go back there up to... for married filing jointly, $78,000 of capital gain is not subject to taxation. So maybe it's not that big of an issue, but it's, we're talking about people who could conceivably be having very big numbers. All right, let's talk about rental real estate a little bit. All right, so as I mentioned, or maybe I mentioned it earlier, don't put rental real estate inside a corporation. Now, why should we not do this? Moving property out of a corp causes a tax event. Transferring appreciated real estate into a corp results in the recognition of capital gains. And there are a couple of other circumstances there. Now, partnerships provide much more flexibility when it comes to owning rental real estate. That's why you often hear investors using LLCs when discussing the entity structures. Now, LLCs, it's really a state defined entity, and an LLC can be a filing as a sole proprietorship and on a Form 1040, just a Schedule C, if it's a sole member, or a partnership if you're a multi-member, or an S corporation. So LLC doesn't really define the type of tax entity. It's a very flexible entity. Transferring appreciated real estate into a partnership is simple. It doesn't come with any tax consequences. So you can contribute a property with a built-in gain, acquire a small interest in the partnership, and not have to worry about taxes. And also, there's something called liability relief, which I won't go into too much detail, but liability relief is only taxable if the relief exceeds the partner's basis. Now, when property is distributed to a partner, no gain or loss is recognized. The partner instead will take on basis in the distributed property. So partnerships are definitely more flexible. All right, so let's see what we've got on this screen. If you generate rental property income, that income can qualify for the qualified business income deduction. We've already spoken about that. But you have to show that your rental is part of a trade or business. Of course, real estate professionals and these businesses all have to file 1099 miscellaneous to their independent contractors. Now, something that business owners like to do is something called self-rental. Rent paid by a sole proprietor to himself for the use of his own property. That's not considered to be a business expense. But there are alternatives, and you can see them up there. So this alternative approach is something, if you're interested in self-rental, you're going to want to pay some attention to. The lessor should assign payment of all operating expenses to the lessee. Rent should be paid to an LLC at maximum fair market value rates for the LLC's ownership of the building. Now, if you're curious about what to pay, what amount of rent to pay yourself, there's a website called LoopNet. Everyone familiar with LoopNet? That'll help you to get an idea of what the fair market value of rentals is. Now, let's talk about flipping. All right, so if you retain the property for more than a year, the profit from the sale will be treated as a long-term capital gain in general. But if you flip in less than a year, your profit is considered short-term capital gain and taxed at ordinary income tax rates, much higher. In reality, the situation is much more complicated than that. The more houses you're flipping, the greater the chance. I wish Don was here. Where's Don? The more houses you're flipping, the greater the chance the government will call it a trade or business. If the IRS decides that your flipping activity is more than just an investment, they'll recharacterize the transactions as a trade or business, and your tax will be higher. And how the profits are handled is also going to be treated differently. You could be assessed self-employment tax on top of your ordinary income tax rates. So I'm repeating what I said earlier. Any questions about any of that? All right, good. So you can get creative by qualifying for a federal tax exclusion on the sales profits if a home is considered a primary residence. I'm sure everyone here knows that if you buy a house and live in it, and then sell it at a gain, that gain is generally not subject to taxation. There's a $250,000 exclusion for a single person, up to a $500,000 exclusion on the gain of the sale of your personal residence for married filing jointly. For someone who's looking to flip occasionally, it's unlikely that the IRS is going to bother you about this, and they'll treat it like an investment. Yes, go ahead.
Is there not a minimum requirement, is there not a minimum amount of time that you have to stay in that primary residence in order for you to be able to take advantage of that? So if I buy a primary residence, but I only live there a year.
I think 2 years is the minimum. Isn't that right, Tom?
It's 2 out of 5. It jumped this year to 5 out of 7.
5 out of 7. Oh, well, I just learned something.
It jumped to 5 out of 7. For the game book. I'm not aware of that. That's 2 out of 5. So that's been forever. 2 out of 5. Yeah, 2 ever. Well, not forever. Before that, it was.
Tom, please use the microphone. I came back just to annoy you.
You missed my whole flipping presentation. All right. For someone who's flipping occasionally, it's probably not much of an issue. But I recall 2 years. If it's 5 years, you got some time to go yet. So we can look into that. Thank you for pointing that out. Now, a decision to flip should never be made on tax consequences alone. Obviously, if you need the money to invest in your next property, there's other factors involved. Of course, you've always got Don if you need some money, right, Don?
Thank you. That'll cost. I'm sure you'll charge me for that.
All right. So home mortgage interest, we talked about that a little briefly. The Tax Cuts and Jobs Act repealed the deduction for home equity line interest. I think Tom should come up here for this one. We're talking about mortgage interest. The only exception is for home equity loan money used to buy, build, or improve the taxpayer's home. So in order for home mortgage interest to be deductible, loan has to be secured by the taxpayer's home. The home must be the taxpayer's main or second home, and the taxpayer must have an ownership interest in the home. Tom, you want to take it from there? All right.
5 out of 7, do you have that somewhere?
Use the microphone.
Was that?
Yeah, I mean, it's as far as I know, it's 2 out of 5 years, but I'm curious what you said 5 because there's nothing even at the IRS website that says 5 out of 7, unless that's a different rule. But basically, there's an opportunity. If you hold it for less than, assuming it's 2 out of 5, there's certain reasons that you're allowed to prorate the gain. So if it's 1 out of 5, or let's just say you were there only 1 year, then you could prorate the gain. Let's say somebody says you got to relocate for a new job. You can actually take a piece of the gain. One other thing on the 179, it has to be new property. I think somebody asked, can you expense used property or something?
Yeah, I think it can be used now.
No, it's used for bonus, I think.
Oh.
It's used for bonus depreciation. So it used to be like I buy an apartment complex and it's got 40 units in it. It's all furnished. I can't bonus depreciation it. I could depreciate it, but I can't take bonus depreciation, assuming you did a cost segregation study and broke everything apart. Now you could buy used property and you can take bonus depreciation on the assets if they qualify. However, you can't do that if you previously used the asset. So like in a conversion, somebody asked about a conversion. Like if it was your house and you just convert to rental, you can't bonus depreciation.
Did you previously describe what bonus depreciation means?
Didn't you touch on that? There's 100% bonus depreciation on certain assets. And one of the things that was mentioned was that, because we're talking about flippers here, so I assume a lot of people might have trucks or cars that weigh more than 6,000 pounds. And if they weigh more than 6,000 pounds, you can actually take 100%. You buy a Tahoe in 2019 for $65,000 and use it more than 50%. So 50% to 100. If you use it 100% for business, you could write the whole Tahoe off in 1 year. 65,000, you can write it off.
Of course, you need the 65,000 first.
Well, you don't even need it. You could finance it. Doesn't matter. You could finance the whole thing, and you could write the whole 65,000 off.
And how much does it have to weigh?
6,000 pounds more than 6,000 pounds.
So I think
so. A lot of like trucks are. I just bought whatever, and it's only. Unfortunately, it's only 4. But
I think a Tesla Model S comes close to that weight.
Does it really?
Because of the batteries.
There's an Audi that qualifies.
Yeah.
The SUV.
Yeah, you just check the weight. I mean, a lot of these big cars, big SUVs qualify for that. So bonus depreciation is, if you do a cost seg on an apartment complex and you throw stuff in 15-year and 5-year and 7-year, you could write that stuff off in year 1, which is another reason not to have it in IRA, because the whole part of the ROI on real estate is to get the tax benefit accelerated. So I know that sometimes the problem is people are retirement rich, and then outside of retirement, they have no money. That's the problem. So you're trying to find ways to buy real estate. So I guess you do what you can do. On the interest, we're talking about interest, I guess? That's what we're talking about?
Well, 14. So who knows the definition of gross vehicle?
Close to the mic, please.
Who knows the definition of gross vehicle weight range? I think it's... They will, but the reason I'm asking is because I don't believe that's the weight of the vehicle. It's actually a rating of the vehicle's capacity. So it doesn't have to be a 6,000-pound vehicle. It can just be capable of carrying 6,000 pounds. I think that's the rule.
Well, the sales guy will definitely know if it qualifies. Because
the sales guy's going to say it qualifies.
Yeah, on technical term, it's 6,000 pounds. I don't know if it's curb weight or what the definition is, but 6,000. Like a Range Rover, it works. A Tahoe, it works. What else is out there? Expeditions, those kind of things would all qualify.
I just looked up a Tesla Model S, and it ranges between about 4,800 pounds to 5,000 pounds, depending on the battery. Not quite 6,500. Repeat the question.
Clarify between 179 and bonus depreciation. They're two different provisions. 179 comes first generally. So 179 is a code section. That's what it stands for. And you can expense property, qualified property up to $1 million. So if you expense property, you can't also bonus depreciate property. So I'm trying to figure out a way to explain this to you. So the limitation on 179 is, let's say you have $100,000 of income in your business, and then you bought assets that are, I don't know, 200,000. You could, and they're eligible to be expensed under Section 179, which comes before bonus depreciation. If you get that 200,000 against that 100,000, you can't use it. 179 has a limitation. The limitation is it can't exceed your income. So in that case, you maybe want to say, I don't want 179. I want 100% bonus depreciation. So you elect out of 179, go to bonus depreciation, which is just a way, instead of depreciating something over 5, 7, 15, they're saying, hey, just take it up front because we want to stimulate the economy, buy stuff and expense it. So you don't use 179, you could write off the same $200,000 under bonus, and you could have a negative $200,000 of income, which might help you then do something like a Roth, or you can carry it forward. You can't carry back anymore. You can carry forward. You can carry that forward. And 179, you can't go negative. So they're kind of like the same, but they're different in how they're treated for tax purposes. So there's benefits to each of them. So if I bought something for $10,000 and it's eligible for 179, I deduct $10,000, then there is no bonus depreciation because my basis is now zero. I wrote it off. Alternatively, you say, I don't want 179. I'm just going to use bonus depreciation. I could still deduct the $10,000. So it's almost like they're kind of very similar. Yep.
In regards to bonus depreciation, for the automobiles, the up to $8,000 deductible depreciated, is that in addition to taking mileage?
No.
You get mileage for that?
You get, for an automobile, which is complicated, and nobody ever tells us the truth when they tell us everything. You either get the actual expenses of the auto, whatever they are, insurance, repairs, gasoline. Am I missing something? Yeah, licensing fees, depreciation. You get all those numbers, whatever they add up to, times your business percent. And there's no way everybody's 100% business. Always, I'm telling you, just do 90. So you get whatever that equals. Let's say that equals $10,000, including the 8 plus your gas, whatever. Then you multiply that by your business percentage. That's what you could deduct. Alternatively, if you don't want to use that method because you don't want to keep track of all those expenses, or you don't want to depreciate the car for whatever reason, you can use the mileage method.
So it's mileage for that?
Yeah.
Okay.
And I think the mileage rate is like 58. I don't even know what it is. Any other?
All right. Let's say I get a repair insurance on the vehicle.
A what?
A repair insurance. Or I have a repair.
Yeah.
On the vehicle. And I'm deducting mileage. I either do the total.
One or the other.
Do the mileage and then also deduct the repair.
No. Well, no. It's one or the other. So it's repairs, gas, oil, licenses, depreciation, whatever the number is for that year, times your business percent. Or you could take the mileage method. You don't get both.
What he's saying is the actual expenses
Near the
may
bike?
be significantly more beneficial than using 58 cents a mile or whatever the rate is, if you're buying a new vehicle for your business.
All right.
If you're just using your vehicle occasionally for business and it's not purchased by your business, then you can the best alternative might be just to take a mileage deduction.
All right, but if you have some significant expenses, it might be better.
Well, you can't switch back and forth. I can tell you that. Am I right about that? You can't switch mileage one year and then actual expenses the next year.
Yeah, you got to stick.
You have to stick with whatever plan you choose
For that vehicle.
for that vehicle.
But if you get another vehicle, sure, and then you can.
Yeah, there's a lot of opportunities to save money
There's
on taxes with automobiles and trucks.
If you're doing that, gasoline you spend, would it also be deductible?
Yes. Every single dollar out of your pocket would be deductible. Times your business percent. I don't care if you buy it in a business or not. It's still, there's no way, even if you buy it in a business, doesn't make it 100% business. It doesn't matter if it's in, there's still always an element of personal use. So I always just like, if I'm handling somebody, I'll just say, you know what, I'm taking 10%, calling it personal. Sometimes I don't tell them, but I just do it.
All right. So
because it's impossible.
I'm sure that
I'm protecting them. Come on.
I'm sure that everybody in this room has heard the expression, pigs get fat, hogs get slaughtered. You ever hear that one? All right. So be careful about taking deductions.
There's a question over there.
I'm sorry, you have another slide there for bonus depreciation, and it says there is certain property in the commercial real estate world that might be deductible 100% under 179 that isn't on the bonus, like heating and stuff like that. Isn't there a subset now under the new law?
Oh, when you're talking about commercial real estate, you might be the only person in the room, but yeah, there's certainly special rules for
Whereas you
for
can't take the bonus
business real
depreciation you can't take bonus depreciation, you can take 179.
Right. We can talk about it after the meeting if you'd like to talk about the details.
Yeah.
I don't think anybody else is
There's a
involved.
bullet point that will on your slide.
What did it say? Which one is it?
Well, here's section 179, but right. I'm going to back up another couple of slides because we talked about non-resencial real property.
It's specific to certain things like heating or something like that.
Right.
Yeah.
So there's certain assets that are part of real estate, business real estate, where you can get favorable tax treatment through the depreciation methods. All right, let's jump to what you're
you
going
wanna
to
do
talk
this?
about.
So just mortgage interest, right? I mean, everybody knows this one?
I wouldn't think so.
Okay. So part of the Tax Cut Act was you can no longer, just I'm going to back up, you can't deduct home mortgage, home equity indebtedness unless it is used, which is, originally when it came out, like, what do you mean I can't deduct it? Only if it's used to improve or build upon your home. Or acquire. But even in that event, the home mortgage interest cannot exceed $750,000 of combined loans. So if you have a shore house or mountain house and a main home, the debt can exceed $750,000, but the interest isn't deductible. And one of the examples I kind of like on, because people do this, and you guys are in real estate, and maybe you do it more than most, is that here it is here. This is actually off the IRS website. In January 2018, a taxpayer takes out a $500,000 mortgage to purchase a main home. The loan is secured by the main home. In February, the taxpayer takes out $500,000 loan to purchase a vacation home. The loan is secured by the vacation home. Because the total amount of mortgages exceeds $750,000, it's not all deductible. So we just talked about that because it exceeds $750,000. In the example where a taxpayer takes out a $500,000 mortgage to purchase a main home with a value of $800,000, in the same year, the taxpayer takes out a $250,000 home equity loan, different scenario, to buy a vacation home. In that case, it's not deductible. So if you use a home equity loan to buy a vacation home, the mortgage interest isn't deductible.
If you do it to buy an investment property, then you can use the expense against the investment.
So that gets into the next part. So the next part is I borrow against my house, and it's I take the $250,000 out in this example that what was your name again? Rich brought up, and I get $250,000 from my home equity loan, which is not deductible because I'm not using it to buy and build my own home, so I can't deduct it as mortgage interest. However, it's still secured by my residence, but I get that $250,000 and I invest it in an investment property. The interest becomes investment interest, which is treated differently than mortgage interest. There's limitations on how much investment interest you could deduct. Are you telling me that? Or are you? Oh, yeah. Oh, okay. I know you. Okay, so.
Well, the 2 out of 5 was valid.
It is valid. 2 out of 5. Okay. I'm like, go back to school. So yeah, it's 2 out of 5. 5 out of 7, then you really get. So you have to trace the money and what you use the money for. It's deductible as in the case of if you're buying land, with the 250 in this example, you borrowed money from your, whatever it is, your residence, and you basically went out and bought land, it would be deductible in Schedule A as investment interest, subject to investment income. Investment income is interest and dividends. But you get to carry it forward if you don't use it. Scenario 2 would be if you bought an operating rental property, then I would not put it on Schedule A. I would put it on Schedule E. Then you get the full deduction in that year. So if you take it out and you take 250 out and you go buy 50 with a car you buy $50,000 car and you put $200,000 in the stock market, how much of the interest is deductible? If you buy stock with it, it's investment interest. You don't have to buy investment property. That's no different than a margin loan.
So what if you buy a distressed property that's not habitable? Is that different from land?
I would just say that's investment interest on Schedule A. I would say it's the same. It doesn't matter. You're holding it for investment. If it's an active rental, then I would move it to Schedule E. If you're just buying an asset, whatever the asset is, I could buy. It's no different than me buying. I could buy Apple stock with home equity loan. If I do that, I can deduct the interest as investment interest. You just happen to pick. You don't want the stock. You want to pick whatever uninhabitable property. Is that? So, and it's really important to trace it. Like if you're going to do that, I would keep the records that show you took the 250 out and you wired the money to the title company and just have all that in your file because you know what? 5 years from now, you'll know, I don't know where it went. And they'll be like, sorry. So keep track of it.
Thanks. All right, let's talk about real estate professionals. Any real estate professionals in the room? Duh. There's a few. You don't have to raise your hands. It's okay. We know who you are. Let's see what we've got here. All right, so in order to be considered a real estate professional, more than half of the personal services you perform were performed in real property trades or businesses in which you materially participated. And material participation has to be defined also. And you perform more than 750 hours of services during the year in real property trade or business in which you materially participated. Now, there's a special $25,000 allowance, which I'm guessing real estate professionals might know about. You may be allowed to deduct up to $25,000 of rental property passive income losses as long as you can demonstrate that you actively participate in the property. And what does that mean? That means you must own at least a 10% interest and you must be making the management decisions. So as a result, if you've got rental real estate and you have a loss, you can take that loss on your tax return up to $25,000. Huge benefit for a small guy who has 1 or 2 properties. In general, you usually can't deduct losses unless they're offset by gains. What was your question?
I'm wondering if you can take any advantage of this if you're house hacking. So if you live in one unit of a property and you rent out the other unit, does it automatically take you out of this because you live in a part of the property? Or can you look for this to apply to the units that are rented?
Is this a duplex you're referring to? Okay, so duplex would really be 2 separate units for all intents and purposes. So one of them is a rental, one of them is your personal residence, right? Yeah, I wouldn't think that's an issue. I don't think it's a problem. All right. Yes. I don't think it matters. I don't remember seeing any.
There's an income limit though, on whether you take it.
Right. I don't know what the income limit. Yeah. That sounds right. Yeah, I think your total income.
If your income's over $150,000.
Grab the mic, Tom, please.
AGI has to be under $150,000. I think there's a phase out period. Phase out. Something like that. Yeah, like 100 to 150, something along those lines. Once you exceed a certain point, you lose the benefit. It doesn't matter. All right, let's talk about planning. All right, now obviously Tom has already come up with a number of things, but just to rehash, there's a 0% long-term capital gains bracket. Take advantage of it. Anybody ever sell anything on an installment sale? There's 1. 2. So you can spread the gains from a sale over multiple years if you arrange the sale as an installment sale. Huge benefit for that. For S corps, I just want to rehash this. Monitor your basis. Make sure you understand what your basis is in your S corporation. Wages are subject to FICA taxes, but distributions from your S corp are not. However, the owner's wage must be reasonable. So this is what Tom was talking about earlier. You can't make $100,000 in an S corp and call it all S distributions. Some of it has to be compensation, and the IRS is going to look closely at whether that compensation is determined to be reasonable. Yeah, go ahead.
I've always been told you can take up to 30%. They expect you to take up to 30%, approximately 30% of your net income. Is that something you've ever heard before? My accountant told me.
Well, there are a lot of rules of thumb, but I think that might or may not float depending on the circumstances. The IRS has a long list. I think there's 20 factors to determine whether compensation is reasonable or not. So some accountants like to use that rule of thumb, and I've seen it before. So that's not the only time I've heard that.
Could you repeat the question, even though you just answered?
Certainly. So the question is, what percentage of your S corporation income should you be treating as wages? And the answer is it depends. Certain accountants will recommend 30% of your income should be treated as wages. I would say that there's a much more complex process to make that decision than just using a rule of thumb. And don't hold real estate in a corporation or an IRA. All right, let's go to the next screen. More planning strategies. Taxpayers may be able to increase their Section 199A deduction. Now remember, Section 199A gives you a 20% deduction on your business income. So there's some planning strategies for ways that you can increase that benefit. You can lower business taxable income by increasing your deductions or spreading the income over multiple taxpayers. You can change worker classification from employee to contractor or from contractor to employee. If you need more details about this, talk to me after the meeting. Change the type of business entity. So if you're a corp, maybe you want to be a partnership or vice versa. Take advantage of retirement plans to reduce taxable income. In other words, maximize your retirement plan contributions. Move your fixed assets into another entity and pay rent to use those assets. That's a little more sophisticated. Shift partners' income from guaranteed payments to distributions if you're in a partnership. And also manage your investments so you minimize your taxable income. All right, I think that pretty well covers it. If you've got any other questions, lay them on us. Go ahead.
You just talked about one way to reduce your Social Security tax to contribute to qualified plans. Is there any other way besides doing that to reduce Social Security tax?
So we talked about ways to reduce your self-employment tax. Is that what you're referring to? Self-employment tax includes Medicare and Social Security, obviously. Obviously, the less self-employment tax you pay, the happier you're going to be, right? So we just talked about some of those ways. If you've got a specific circumstance, I'd be happy to talk to you about it. Go ahead.
The personal exemption was increased to $24,000 for couples filing.
Married filing jointly, yeah.
That wiped out a lot of charitable contribution deductions.
Right.
Can those same contributions be made by our businesses and be able to be written off?
The answer, I think, is no. That is a simple answer.
Tom,
So
grab the mic.
the question was, can we deduct charitable contributions in any way other than on your Schedule A, essentially? Is that essentially what you're talking about?
It shifted over to the business because the personal exemption.
So I guess I would say that certain types of charitable contributions could be considered having a business purpose. Why don't you come and talk about that?
So most people in real estate own flow-through entities, right? Because you want the benefit of the losses up front. So in a flow-through entity, like I'm a flow-through entity, and I think you're a flow-through entity, right? So I have a business partner. So if I make $1,000 contribution, it flows through on my Schedule K1. I don't know if you're familiar with that, but it flows through on K1, and it goes to Schedule A. The only way for a business to get it is if you were a C corporation, because there's no flow-through. So a C corporation would get the benefit, but then it's a C corporation, which is not an ideal situation. That's a double tax entity. So the answer as Elliot kind of pointed out, is really you can't shift it.
There's certain.
You can bunch. I think you heard we could bunch you if you're a charitably inclined person, and let's say you're running up against if you're married, the 24,000. There's things you could do to get over that. So let's just say, and there are people. I mean, let's say I don't know how much you give, but let's just say you give $10,000 a year away. But you're still not over the 24 because you have your real estate taxes and et cetera are limited to 10,000, but you get the $24,000 exemption. You can basically say, I want to give 3 years of charitable contributions up front to what's called a gift fund, like a Fidelity gift fund, charitable gift fund. You put it in the gift fund, 30,000, not that you can afford to do this, but I'm just saying, if you could, because you're going to do it anyway, and you can get a benefit, you put the 30,000 in the gift fund, and you get to deduct it in the current year, so you're way above the 24, and then you give it away out of the gift fund over 5-10 years. You could disperse it. So it's like bunching all your charitables to 1 year.
With the government increasing the standard deduction to 24,000, how did that affect what nonprofits and charitable organizations were receiving?
The problem.
A lot of people were counting on that.
Yeah, but I think people donate not for the tax. I mean, wealthy people I have a lot of wealthy clients. It's irrelevant to them. I mean, that's irrelevant. They just still give what they want to give. And then, I mean, did you stop giving because you're not getting a benefit anymore, really? I mean,
I didn't, no.
yeah. I mean, I think where it cut people off, where it cut people off is like people who made up the non-cash, because the non-cash is a big black hole. I mean, it's just people make that up. So non-cash contributions. I mean, it's just like, okay, my underwear are worth, $5,000. Like, come on, they're not. You know what I mean? That's what people who write a check are still writing checks, I think.
Well, in this scenario, I own a Schedule C business, ABC business, and the Doylestown Festival comes to me and says, we'd like you to donate the band shell money for our Doylestown Festival, which only runs about 2 weeks. It's going to be $5,000. We're going to put your ABC business name on it. I would call that marketing, would you?
No.
You would not call that advertising?
Technically, it's quid pro quo. So you know what that means, quid pro quo? It's like bribery. So no. So it's kind of like no different, but
that's quid pro quo too.
Well, so yeah, it's no different than an easier example is like I go to the Boy Scout charity auction, and they have the Foles doing whatever it was. What was it called? The Foles was the Philly special, in a thing, right? And he signed it, and you bid $1,000 for it.
That's completely different.
No, it's a similar concept though.
Doylestown Festival, 50,000 people come, they see my name at the bandstand. It looks like advertising to me. That's my question. They're literally calling it advertising on the sheet. So I'm just curious.
I mean, I would probably take half.
I mean, how's it different than Bucks County Herald charging me for a business card in their paper?
So when you write that check from the business, you're writing it to an entity which is a nonprofit entity.
Yes, but they also make money at that festival. They have to report it.
No, I understand that, but I think
I think it's charitable contribution. My gut is it's charitable contribution.
Okay.
Because it's going to a nonprofit. If you write the check to Tom, that's a different story.
Okay.
Maybe Tom would take the deduction, or you could take the deduction if you pay Tom.
So
I'd almost argue it's not worth $5,000. I think they should the charity should, you're getting a benefit. I don't know the benefit because I don't know the benefit of.
Yeah.
It's no different than the charity auction kind of.
I'm curious on your take.
I think it's I've done it. It's just charitable.
One simple thing to do is put all your charitable contributions into 1 year and then skip the next year. Just every other year do your charitable contributions. That could have a significant benefit for you.
What was that fund that charitable fund that you just mentioned? What was that?
So whenever you give stuff away, if you're charitably inclined, if you have stock, first of all, if you have stock, you should always give away stock, not cash.
Why?
Problem is most people don't know how to do it, and they just don't even know about it.
Explain why.
What?
Explain why.
So if I have I want to give 5,000 here, just example here. I want to give 5,000, and they don't even care. You could do this. I want to give, what was it called? Doylestown. That's actually the organization? All right, so I'm going to give he can write a check for $5,000 to Doylestown Festival, right? Or he can basically say, I'm going to give them $5,000 worth of Apple stock that I paid $1,000 for. Because he bought it for $1,000 and the stock went through the roof, and they think it's going to go to $400 now. So that $4,000 gain, if he held it for more than a year, he could basically give Doylestown Festival $5,000 worth of stock. They could care less. They're going to get it and sell it. They don't pay tax. They're a tax-exempt organization. He gets his $5,000 deduction, right? And he never pays tax on the $4,000 gain inside of the stock. Alternatively, for him to raise $5,000 cash, he'd have to sell $7,000 of Apple stock because he's got to pay tax, right? So he's saving, it's like double. So the other way to do it is if you have a portfolio, you're fortunate enough to have a portfolio, is I know I give $5,000 to the Doylestown Festival every year. I'm going to do it for the next 5 years. I want to get $25,000 of Apple stock, and I'm going to put it, but I don't want to give it to him yet because I might not like him next year. So I'm going to put $25,000 in this Fidelity gift fund, which is like your own little private foundation. It's like a 401k, and it's like your name on it, the Joe Smith Foundation. You put $25,000 Apple stock, they sell it, they put it in the Fidelity funds, whatever you pick, whatever bucket, aggressive, and it sits there, and you get the deduction up front of $25,000, and then you log in online and say, hey, you know what? I want to send $200 to Boy Scouts. I want to send whenever you want. You could take 10 years to get rid of it, but it allows you to bunch it together. That's kind of.
There's actually another way to save money on charitable deductions, I think. You can take money out of your IRA and go directly from the IRA to the Doylestown Festival, whatever it's called. As long as you don't touch the money, then that money is taken from your IRA to Doylestown, tax-free to you.
Okay, so that example, if you're 70.5 and you're taking minimum distributions, required minimum distributions, none of you guys look that old, so I didn't think about that.
Does it require that? Is that right, or can't you?
Yeah, so you could. So if your minimum distribution, so the IRS says when you're 70.5, and now it's going to be 72 for after 2020, but right now it's 70.5. Whatever your IRA balance is based on your life expectancy, you have to take out X dollars. So let's just say your minimum distribution requirement is $50,000. Yes, you have to take out. You can actually, as you mentioned, just get that money, because if you take out the 50, you have to pay tax on it. You can direct it right to the Doylestown Festival. And then if you do that, you don't have to report it on page 1 of your tax return. No, the benefit of that is for people that are getting Medicare, right? Your Medicare rates go up every year because it's based on your AGI. And I think once your AGI for a married couple goes over 170, you're $170,000, you're paying the maximum rate. And if in that 170 is $50,000 of IRA distributions, a great way to reduce that is say, all right, send that right to charity. I don't have to report it.
I didn't realize you had that you had to do that if you're only over the.
You can only do it if you only do it.
Okay, I thought it could be done at any point in the IRA life.
No, it's 70.5.
Okay.
And the other thing is, well, the con against that is, I don't know if you want to say anything. But the con against it. So here's the flip side of that. For somebody who says, I don't care about the 170 or Medicare, I'm going to give $50,000 to Doylestown Festival anyway. So, and I have Apple stock in my portfolio that I paid $5,000 for. It's worth $50,000. I'm going to give them the $50,000 of Apple stock. I still get it as an itemized deduction, right? Because I gave it away, and I paid no tax on the gain. Now I still have to take my $50,000 out of the IRA, right? I'm so net neutral. I'm net neutral, right? Because I took 50 out, it's taxable, and now I have this deduction of 50 on my Schedule A. So I'm net neutral, right? And I get that 50, and I basically go put it back in my portfolio and rebuy Apple, and I stepped up my basis, right? I can rebuy Apple, and now my basis is 50. So there's different ways to think about it.
Could you pick a portion, like say you have Apple stock, you bought some real cheap?
Yes.
You bought some more expensive?
Yes.
Could you pick the more expensive stuff?
No, you don't want to pick you want to pick the cheapest, the stuff you bought for the least amount. Right? Because you want to get, because if you don't, then you have to pay tax on the gain. What do you care? If it's worth $25,000, it's worth $25,000. Who cares what you paid for it? So you want to get rid of the biggest gain piece. So if you ever have to sell it, you pay less tax. So you want to get rid of the piece with the large, whatever you look in your portfolio, whatever stock has the biggest unrealized gain is what you want to give away. Because basically you're saving 20% on that.
And you just could pick that piece up.
You could say, you call your broker and say, I want to send these 2 shares that were bought in, 2008, 8. Yeah, pick whatever you want. I do it all the time. Do it all the time. So
Another question in the back.
If you're required to do a minimum required distribution, what's the best way to shield that, to take the money out of, say, a 401k and put it into a Roth? You're looking at me, I was thinking like a property depreciation, you depreciate the property, and that gives you a deduction, and then when you pull the money for the required minimum distribution out, that's taxable, but then you got that deduction.
yeah, I think we kind of touched on, you may have come in.
Yeah, could you
Come
repeat
in.
the question, please?
Did you come in a little later?
Yeah.
Okay, so I talked about that. So in a year where you have, and I talked about in the case like of a medical deduction, somebody has significant medical expenses, same kind of concept, right? You have a lot of deductions. You want to make sure you use them. So doing partial Roth conversions, is that what you're talking about?
Yeah.
So you're talking about I have a real estate loss, right? And I don't want to use it. I don't want to waste it. It's no different than having a medical expense deduction or a charitable deduction. I want to use it, right? So you want to generate income. So you could do a Roth conversion to generate income. That's what you're saying, right? To convert part of my IRA to a Roth. I think that's what you're saying.
Yeah. Is there a better strategy than that?
For what? To get to a Roth, or what's the?
To take money from a 401k and put it into a Roth without a tax consequence?
You can't avoid tax consequence. Only if you have.
Well, all right. So that you don't pay taxes on that money.
You give it to charity.
So when you have a
Give me your own
deduction,
charity.
when you have a
No.
deduction that you can't use, like a huge medical expense, then you can find ways to generate income by doing a conversion from a 401k to a Roth IRA. That results in a taxable event. And that way you can use your loss or your deductions or your other expense to offset that gain. So it's a good strategy for
But if you
taxpaying.
set up your own nonprofit, it's a legitimate nonprofit.
That might be outside the scope of.
No, you can't. You can't. So, because I do this with estate planning. So people who maybe don't want their IRA because they're going to give it to charity, you can't name your private foundation. That's what you're talking about, private foundation, which would be owned by you. It has to be a 501c3. It has to be like the Boy Scouts. Or it could be a charitable remainder trust, which is a great idea.
Well, if you set up a 501c.
Yeah, but it's got to be a real 501c3. Is it? It's got to be a real entity. It's got to be a real entity. It can't be.
It's a real entity, and it's doing property development or something.
I don't think you'll get grant. It has to be. And if it's doing property development and it's giving those houses to underprivileged families, that's a charitable purpose. You can't just open a charity for a 501c3 for any purpose. And you have to file with the IRS saying, "Here's what we want to do. Do you approve of it? Yes, no, maybe."
Right. And if you're then being paid to manage it as the president or something like that.
So you're getting involved. Could you do that hypothetically in a large scale? Yeah, you can get paid from a foundation that you establish, but you're dealing with, there's something called self-dealing, which is why you don't want to have real estate and IRAs, similar concept. You don't want to, self-dealing. You're developing properties. All of a sudden you develop a property at the Jersey Shore and you decide to stay there a week. Guess what? You screwed the whole foundation up because you just used it personally. So, or you're taking too much compensation. The IRS is very focused on nonprofits, so you got to be careful.
Steve,
There's
there
a lot
are
of overhead involved in doing something like that too.
Yeah, there's a lot of compliance related to a
yeah,
nonprofit.
Steve, there are very carefully defined
Yeah,
things that a nonprofit can do.
right.
Being a flipper nonprofit, I don't know qualifies, for example.
Yeah, but you could, if you do a charitable remainder trust, you could send your whole assets to a charitable remainder trust for your kids, or even with the stock. You could do it with the stock, but charitable remainder trust, set yourself in an annuity for the rest of your life, and just you pay no tax on it. It's like the greatest thing ever.
And Tom is the expert on charitable remainder trust.
I love them.
Any other questions? Yes.
Someone mentioned to me, I don't know much about it at all, so my question isn't that sophisticated. It's more so, if you know anything about it, you can tell me that will lead me in the right direction. But I understand that if you're gonna be self-employed, you can set up your own pension plan. Is that a complex?
Well, when you're self-employed, you can certainly set up numerous varieties of pension plans. It depends on the type of business you have. There are some costs involved in setting up a 401k, even if it's a solo 401k. But yes, absolutely. And if you're interested in more details, we can certainly talk about that. Yes.
I had a question about 401ks, and I keep reading online that the maximum you can contribute is $54,000 total. But in your own 401k, you can only contribute like $19,000 or so, and a portion of it is your employer who matches maybe part of it. So how do people get up to the 54,000?
I think you're talking about a profit sharing plan. And
Yeah, it's 401k with profit share. That's what it is.
you want to talk about this?
This is like kind of a complicated group here.
Yeah, coming up with good questions.
So you can contribute, I think it's actually higher, well, I'm over 50, so it's more money. So you can actually put, what is it, 50, it might be like 58,000, I don't know what it is this year.
It goes up every year.
So you have to have a 401k plan. You can only put, what's this year, 20,000? 20,000, 21,000 maybe. I don't. 21,000. If you're over 50, you could put an extra couple grand in. I think it's up to 25,000 if you're over 50. So I have a solo 401k for our little company, right? And we have profit sharing attached. So depending on how much we make, it's also dependent on how much you make. We could put up to like 58,000 in per partner. But because I have employees, I also have to. If I do profit sharing, I have to give to those employees too. So
that's not as bad as it sounds, by the way, because there's ways to make classes of employee.
But you don't even need a 401k. You could just do a SEP. A SEP IRA limit is the same. It's 58,000. Of course, you need the income. A SEP basically is 20% of your income, is roughly. So if you make, 200,000, you could put 40,000 in a SEP. Can you get more in a 401k profit sharing? Yeah, but you have to pay somebody to set it up, and there's more fees involved.
Can you explain a solo 401k? Because you mentioned it a couple times, but I don't know if everybody knows what that means.
It's a 401k for somebody who's self-employed, doesn't have more than one partner.
And what are the advantages and disadvantages?
The contributions, as opposed to an IRA, which is 6.
Closer to the mic, please. I need to record your wisdom.
So if you make $50,000 and you have a SEP IRA, you can only put 10,000 in. If you have a solo 401k, you can put, and forgive me if I don't know what it is for 2020. You could put, of the 50, you could put 21,000 in. So there's not an income limitation. It's just up to the income. You could put all the way up to the 401k limit. So for solo 401k, really, there's no fees. I have actually it's called the Safe Harbor 401k because I have employees. So it's a little different. But I don't know if that answers your question. I mean,
Actually, based on what you just said, I actually have another question. So say you have a regular W-2 job, and you're putting the maximum $21,000 or whatever, and you have like a side business, side hustle. Can you put more, or is the $21,000 limit for your W-2 like your side hustle?
no, if it's a separate occupation, like I have clients who are they're like some are executives and they max out their 401k, but they're also directors of other companies or on boards, and they receive board fees. So I have IRAs, SEP IRAs set up for them. So you can go over that threshold if it's a distinct business. Yeah, it's just.
You can't take your income from both side hustles combined into one. There's no exceed that.
But it's 21 for each.
So your employer will have a 401k, and then you open one. If you have your own like 1099, whatever you're doing, I don't know what you're doing. So you could do whatever you want, a SEP or 401k or whatever. The limit, how much you put in depends on your income or what you set up.
Yeah, so say you go solo 401k.
Then you could put another 21 in.
This is actually related to local taxes. Abington has a 1% gross income tax,
Earned income tax?
or whatever. but it's based on gross income, as I understand.
That's the business tax.
Well, there's also a
Right,
business
for my-
privilege tax, which I believe is 0.15% of gross receipts.
So-
So you might be mixing up two different types of
Maybe I
tax.
am. But how do they determine what my business income is? Is it everything that's deposited into my business LLC's bank account?
Well, if we're talking about business privilege tax return, if we're talking about a business privilege tax return, then they're going to ask for page 1 of your Form 1040 to determine, or your business tax return to determine what your gross receipts are. And it's going to be based on the gross receipts that are shown on your federal return. So in case where you make $100,000 of gross receipts in your Schedule C business, you're going to owe business privilege tax equal to a small percentage of those gross receipts.
So there's one in East Norton.
Well, so specifically, this year, if I deposited 300 grand into my business account through flipping and contracting and all of that, but $100,000 of that money that was deposited into my checking account came from HELOC loans from me personally to the LLC.
Well, that's not income.
Do they count that as income?
No.
Because I gotta pay it back.
Right.
It's just whatever's in the top line of your Schedule C, whatever you file.
So who's doing your bookkeeping where they're counting that as income?
On everything that got deposited into my account.
Well, who
last
charged you?
year. Everything.
Well, then just tell them that you have to just show them it's a positive.
Who's doing the
It's like
bookkeeping
all
and
our
showing
capital
that?
contributions.
Yeah, it doesn't make any sense. You need somebody to take a look at the way.
I swear it's wrong all year. I've been bitching like a lunatic to Rich about it.
Yeah, the other thing I've done is like, because you said you're a contractor, is that? So, like, you price out a job, and let's say it's $50,000 to redo this house, and then you should ask your accountant this, and then, but of the 50, you're paying subs, right? You're reimbursed. They're sending you a bill, and you say, I would exclude that, and they should go pay their own tax. Like I'd basically say it's basically you're getting reimbursed for subcontractor fees. There might be a way to exclude that.
Does that answer your question, Kenny?
Did you ever do
Just-
that?
Oh, yeah. So I know the city of Philadelphia has explicit regulations about that. The local townships are a little bit more of a problem, but Philadelphia says that if you're paying contractors to do work, like if, let's say, you're a general contractor and you made $1 million, but you paid 800,000 of it to contractors without marking up any of their bills, then you really only made $200,000, and that's the amount of tax of income that you have to report on your Philadelphia business privilege tax return, or business income and receipts tax return now. And I think that the same concept could be valid for what Tom was saying. So basically, what we're talking about is instead of gross receipts, gross profits would be, I guess, the substitute phrase for that, because you deduct the cost of goods, the cost of the contractors. Yes.
Following up on the SEP and the Simple K, if your income is completely passive, other than paying yourself a salary and getting involved in the self-employment tax, is there any way, if your income is all passive, to get involved in
I don't think it matters if your income is passive or not to make.
He can't do a SEP on passive income.
Can't do a SEP on passive income. Man said.
What about Simple K?
No.
You have to have earned income and pay the self-employment tax in order to be able to.
So you have no earned income. So I would agree with that. Okay.
Yeah, if you have income, well, you can pay yourself more salary, you pay more self-employment, you pay more social security.
Then I gotta pay 50% in self-employment.
So Tom, what I'm hearing from you is that Schedule E income cannot be used for making contributions to a retirement plan.
I would say only if it's a trade or business.
Okay. And
I'm sorry. I need to hear what
only
he
if
just said.
it's for trade or business. So
Okay.
what if we're going to treat it as a trade or business, issue 1099s, so we can get the Section 199A deduction? Would it qualify then?
There's different,
You can talk to Tom about that after the meeting. Yes.
Yeah,
Right.
So what if I decide to give, like I have 500 people, I want to give them all a gift of $25. Value. So can I just take that 12,500? Can you just deduct that, or do you need to show that each person received a gift value of $25?
Well, you'd have to show it in the case of an IRS audit, and that certainly sounds like it might qualify for one. But I guess it depends on the circumstances. I'd have to know more about the situation. Anyone else? Yes.
What about a health savings account? Doesn't that allow you to shelter more money?
Health savings accounts actually are a good vehicle for healthcare expenses. That's something that we haven't covered here. So if you want some more information, let me know.
But don't you,
Somebody was looking for better ways of sheltering money in their business.
Oh yeah, health savings account. Thank you for coming. Health savings account's a great vehicle for sheltering some money for.
but don't you have to ultimately spend it for healthcare?
Well, yeah.
Well, wait a minute. In the end, it's sitting there. If you haven't spent it, it becomes part of your retirement, right? And you can invest it.
I don't know the answer to that. You know the answer to that?
I haven't.
I think I'll make it sound like a good answer. So
It's all about how you say
the nice part about the HSA is you could take it out for any reason. The question is it subject to, tax and penalty, right? So you can put whatever it is. I don't know what it is for married, 5,000, or it's even higher than that, I think. Isn't it HSA? 7,000? You could put 7,000 in for the next 10 years, assuming they're still around. Never draw on it, invest it in, there's some funds you could invest it in stocks and Apple stock, et cetera. And then you could take it out 10 years from now. You'll still pay tax and penalty because if you don't use it for medical, but if you kept all your receipts for 10 years and just say, I'm going to pay out of pocket all my medical, right? I'm going to pay all my medical every year. And then I keep all my receipts and you take everything out in the 10th year to reimburse yourself for the past 10 years, it's not subject to tax or penalty. So you can accumulate all your receipts. So that's it's a powerful tool if you don't.
But the receipts have to be for medical.
Well, yeah, right.
I thought there was a way at the end that you could actually get that money that was in there without any penalty.
If you have the receipts
For medical.
at the end, you just keep them all every year and reimburse yourself at the end.
Remember, the investment grows tax-free. Great benefit.
What you can do, Steve, is buy one of those 6,500-pound trucks, run over your foot.
Right.
What about Medicare? Is that a deductible expense for the health savings?
If you're on Medicare, you can't do an HSA.
Yeah, they're mutually exclusive.
You can't do it. You
No,
can't even,
but I mean,
you can't fund it. You can't.
HSA before.
Oh, no, is that, and you froze it? It's like, just has a balance still left in it?
Yeah.
I would, yeah, I mean, that's okay, but you just can't keep funding it. That's probably okay. I'd have to check that, but that's probably, whatever falls in definition of, it probably includes premium. So I would think you can use it.
So
You can't fund it anymore, right?
So we haven't talked about Social Security. For those of us who qualify, has there been a change in the taxation of Social Security income with this new tax law?
Not that I'm aware
No,
of.
no change, no change.
No change. Okay.
They left it untouched. Is she happy?
Do we have any other questions? Or have we worn all you guys out? Okay,
Thanks a
well,
lot.
that's Elliot's contact information. I'm sure he'd be more than happy to take your call or email,
Or refer you to Tom.
or refer you to Tom or anyone else. And I want to thank all of you for coming tonight and asking lots of very good questions. Did you expect this much?
This
These
is
many
great.
questions? Okay. Let's
very
give Elliot a great round of applause. Thank you.